everyone loves the simple version of UAE story. No personal income tax, business-friendly ecosystem, international clients, relocation, and a company that looks strong on a global contract. And for many tech founders, the UAE really can be a strong base. But it is not the shortcut you buy with a license. The first question is not, can I open a company there? The first question is, can my business actually operate through this structure? Where are the clients? What are we selling? Who manages the company? Do we need visas? What does the bank need to understand? What happens when corporate tax, VAT, substance, and reporting appear after incorporation? This video is a practical founder's guide, not to sell you a country, but to help you decide whether the UAE fits your business model.
For a tech founder, the UAE has real advantages. It is commercially active, globally recognized, and it can work well for founders who want a base between Europe, North Africa, and Asia. For a software company, IT consultancy, or cross-border services business, the UAE can offer a recognizable corporate address, access to free zones, founder residence options, and a market where international business is normal. It can also be attractive for founders who are relocating, building a team, or selling into the Gulf. But those advantages matter only if they connect to the way the company will make money. A SaaS company with global clients does not need the same setup as a consulting company serving UAE clients. A founder who relocates does not have the same substance story as a founder who wants a paper-only structure. That is why we look at the UAE as an operating model, not as a label on an invoice. When founders say, "I want a UAE company," they often mean three different things. The first option is a free zone company. This is often the entry point for international tech businesses, especially when the activity fits the zone. The clients are mostly outside the UAE, and the founder needs a controlled setup with a license, possible visas, and a clear registration path. The second option is a mainland company. Mainland becomes relevant when the business needs to operate more directly inside the UAE market, sign certain local contracts, employ locally, or build a stronger local presence. The third option is offshore. Offshore can have a place in holding or asset structures, but for a normal operating tech company, one that invoices clients, opens accounts, hires people, and builds a commercial profile, it is usually not the main answer. So the question is not which one is cheaper. The question is, which structure matches the revenue model, clients, activity, and operational needs of the business?
The most common myth is that a UAE company automatically means zero tax. It does not. The UAE corporate tax system has a 0% rate on taxable income up to AED 375,000 and a 9% rate above that threshold. For free zone companies, 0% can still be available on qualifying income, but only if the company meets the conditions to be treated as a qualifying free zone person. That is a legal status, not a marketing phrase. Activity matters. Type of income matters. Substance matters. Accounting matters, and if the company has UAE mainland revenue, non-qualifying income, or weak operational logic, the tax position may look very different from the brochure. VAT is a separate question. The standard VAT rate is 5%, and mandatory registration is generally triggered when taxable supplies and imports exceed AED 375,000. For SaaS, consulting, marketplaces, and IT services, VAT should be checked before the first serious invoice, not after the accountant starts asking questions.
For many founders, the UAE decision is also a relocation decision. A company may help create a route for residence, but visa strategy, founder presence, family needs, office arrangements, and real management should be considered together. If the founder is actually moving, the story is stronger. The company, management, and personal life start to connect. If the founder is not moving and everything stays elsewhere, clients, team, management, operations, then the structure needs to explain why the UAE is the right operating center. Substance does not always mean a large office and many employees from day one, but it does mean that the company should not exist only as a PDF license. There should be a credible business reason, a management pattern, documents, accounting, and an operational setup that can be explained.
Registration is also not the same as banking. A company can be incorporated, licensed, and still not have a bank account ready to operate. Banks and financial institutions want to understand the activity, the client geography, source of funds, contracts, invoices, website, founder background, and why the UAE entity exists. This is where many cheap setups break. The license was selected because it was quick, plus the banking story was never designed. The activity wording is too vague. The client route is unclear. There are no contracts. The website says one thing and the license says another. From the founder's perspective, it feels like the bank is difficult. From the bank's perspective, the company is not easy to understand. So, before registration, the founder should ask, if I showed the structure to a bank, would the business story make sense in 5 minutes?
The UAE can work well for several tech models. For example, a founder who wants to relocate and build a real operating base. It can also be a match for a SaaS company with international clients and a clean subscription or service model. An IT consulting or development business that needs a more internationally recognized corporate profile will probably feel comfy there too. It's also a nice find for a founder targeting North African clients or partners. Or, let's say, a team that wants visas, a commercial license, accounting, and a structure that can mature over time. But the UAE is ultimately not a magic answer for every business. If all clients, all management, and all operations remain in one foreign market, the UAE company may not solve an actual problem. If the business is regulated, fintech, crypto, financial services, payments, or investment products, the license discussion becomes a separate compliance project. And if the only reason to choose the UAE is someone told me it is cheap and tax-free, that is not a strategy at all.
Before you open a UAE company, map 5 things. First, clients. Are they outside the UAE, inside the UAE, or mixed? Second, revenue. Are you selling SaaS, consulting, development, marketplace services, AI tools, or regulated products? Third, people. Who manages the business? Where is the founder? Where are the contractors and employees? Fourth, operations. Do we need visas, office, local expenses, bank account, payment processors, or a local market route? Fifth, maintenance. Can the business handle bookkeeping, tax registration, renewals, and document requests every year? If the map points to the UAE, then the setup becomes much easier to design. If the map points somewhere else, it is better to know that before you pay for the license. The country should not be the first decision. The business model should lead the country choice. At Icon.Partners, we start with MedMac. We help tech founders understand whether the UAE fits the company they're actually building. Revenue model, client geography, tax logic, free zone or mainland route, banking story, relocation, substance, and ongoing maintenance. The goal is not just to register a company. The goal is to build a structure that can be used after registration. For invoices, contracts, clients, banking, hiring, and growth, the UAE can be a strong jurisdiction, but it works best when the structure follows the business, not the other way around. If you are planning to open a UAE company for a tech business, start with the operating model. Then choose a structure and then register.